In my Dividend Growth Portfolio, or DGP as I call it, I reinvest dividends once each month in the middle of the month. The amount I invest varies each month depending on how much in dividends I've collected in the previous 30 days or so since I made the last reinvestment. Today I want to tell you about the reinvestment I made for August 2021. I'm Dave Van Knapp for the Dividends and Income channel. Please help us out by clicking the thumb up button if you like the content of this video, subscribing to our channel, and ringing the bell so that you get notifications when we post a new video, which we're doing about once a day now. Thank you. This is my dividend reinvestment program so far in 2021. As you can see, I keep track of it by month, what I buy that month, how many shares I get, and the annual income that purchasing those shares adds to my annual dividend run rate. I've highlighted a couple of things to bring to your attention on this table. One is in the stock purchased column. I've highlighted 3 places where it says new, and that indicates new positions that I started through dividend reinvestments. That's one of the advantages and one of the reasons that I don't drip dividends, rather I accumulate them and then reinvest them once a month. It allows me to redirect the money from things that I'm already invested in into new positions. And this year so far, I've started 3 new positions via the dividend reinvestment program. In the upper right, I highlighted something on the January entry. I simply wanted to note that I just switched to dividend reinvestments monthly this year in the beginning of the year. Formerly, I let dividends accumulate to $1,000 and then reinvested that block of money. And that gave me 3 or 4 dividend reinvestments per year. And the blocks of money were coming along swiftly enough that I decided to switch to monthly reinvestments this year. And that means that each time I reinvest, I have somewhere in the $400 to $600 range, which of course will grow as the dividend run rate grows over the next months and years. And finally, in the lower right, I highlighted adds 2.4% per annum so far. What I'm doing there is I'm accumulating the monthly totals of dividends that are increasing the run rate and then adding them up to get a yearly total so far and dividing that by the amount of money that I was getting as an annual run rate at the beginning of the year. And that tells me how much I've increased that annual run rate through dividend reinvestments up to the point of the chart. This chart runs through my last dividend reinvestment in July with $117 in annual dividends added. Adds 2.4% so far to the annual dividend run rate of the portfolio. In other words, if I did nothing else, if not a single stock in the portfolio raised its dividend in a year, and all I did was reinvest the dividends, I would still be increasing the annual dividend output of the portfolio. And so far this year, that would amount to 2.4%. And as the year goes on, that will climb past 3% and end up the year somewhere between 3 and 4%. Going into this month's reinvestment, I have about $600 accumulated since last time. And what I decided to do was to continue to grow my position in Merck, the pharmaceutical company. Merck has gone from a speck of a position, just 2 shares when I first bought it, a few months ago to about 1% of the portfolio now, and I want to continue to build it. There are 2 main reasons that I chose Merck for this month's reinvestment. The first is shown on this display. The company has an extremely high quality. This is my Quality Snapshot for Merck, which I've talked about in the past. I use ratings from different sources, information providers, to get a fix on the quality of a company in a way that I can do in a fast fashion when I am not going to do a deep dive into Merck's financials and so on. I've already done that deep dive several months ago, but this slide shows how the information providers summarize some of the things that I'm interested in. I'm not going to go through each one, but all of the green is good. I use dark green for the highest ratings, the lighter green for second highest rating. There are 5 categories altogether, and you can see that Merck scores either highest or second highest in all 5 categories. And if you look in the far right, that gives Merck a total of 24 points out of a possible 25 points, which is an A score. Merck is simply a very high quality company. I include that quality snapshot when I create this kind of display, which is Merck in a nutshell. It covers several aspects of a company that I'm interested in when I'm deciding whether to invest or reinvest in it. You can see that I have the quality snapshot that we just saw broken out on the previous slide, just summarized here, the 24 out of 25 points and the A rating. Next to it is a column called valuation, and I consider Merck to be 11% undervalued at this time, which is good news for a buyer. And I want to say a few words about Merck's valuation. This chart shows Merck's price over the last 5.5 years or so. And what I want to point out to you is a situation that as a value investor I often see, and it's one of my favorite scenarios to buy a stock. What the slide shows you is Merck's price over the last 5 years, and I drew the little green line and arrow to show you that Merck's price has basically gone flat for about 2.5 years. For holders of Merck, they may be unhappy with that. Merck's a high quality company. They bought it to make money. Its price isn't going up. As an accumulator of Merck shares, I'm very happy with that. Down towards the bottom edge of this display, I've highlighted that Merck has increased its earnings every year while its price has been flat. With a slight drop in 2021, Merck is forecast to continue to grow its earnings out as far as the chart runs in 2023. In this situation, the sideways movement of Merck's price while Merck's earnings are going up is fine with me because I'm accumulating its shares. Long term, once I own a substantial portion in Merck, I will want Merck's price to rise in step with its earnings increases, which is how most people think the market works all the time. But the market doesn't work that way all the time. Sometimes earnings are out of favor. A company may be out of favor with the market and its price stays flat, which is the case with Merck. Other times a company's earnings may be going up slowly, but its price goes up very fast because the sentiment in the market is to favor that company. But this particular scenario where the earnings are going up, but the prices stayed flat for months or years in Merck's case, tends to mean, or often is a situation that you'll find when a stock is undervalued. And that's the kind of stock I like to buy. A high quality stock with rising earnings, no apparent problems on the horizon, and yet its price hasn't been moving. That's a great time to be buying shares on sale. When I say that, it's fine with me if Merck's share prices stay flat while I'm buying its shares. That puts me in league with Warren Buffett. Buffett, in explaining one time to a group of investors his philosophy in this area, said this: the logic is simple. If you are going to be a net buyer of stocks in the future, and that's what I am with Merck, I'm intending to be a net buyer, not seller of Merck shares, you are hurt when the stock's price rises. You benefit when the price swoons, or in Merck's case, stays flat. And the reason should be obvious. You're getting to pick up shares of a high quality company with growing earnings at prices that don't stay up with the quality of the company that you're getting. Let's come down from the mountaintop with Buffett and talking philosophy and see what I did with this repurchase of Merck in August. I bought 7 shares. Total cost was about $550, and the annual dividend added to the portfolio's run rate of dividends is $18 a year. This slide shows the impact on my portfolio's annual income of buying the 7 shares of Merck with this dividend reinvestment. My annual income run rate was $5,061, a yield on cost for the portfolio of 10.8%. Before the purchase and after the purchase, adding the $18 that we saw on the previous slide, the annual run rate jumps up to $5,079, and it just inches the yield on cost of the portfolio up to 10.9%. And I should add that I made this purchase in plenty of time to get Merck's third quarter dividend, which they will pay in October. And now we come back to this slide, which shows my dividend reinvestment program for my dividend growth portfolio, with August now updated on the basis of what the information we've just seen. So for August, I show the stock purchase being Merck, the 7 shares that we saw on the previous slide, the $18 in annual income added. That increases the bottom line, total annual income added for the year so far, to $135. And now it says I've added 2.8%. You may recall from the earlier slide that was 2.4%. And that shows how each monthly purchase of a few new shares here and a few new shares there slowly inches up the annual dividends that I can expect to get from the portfolio. Okay, I just have a couple of closing thoughts on what we've been talking about. First, these monthly dividend reinvestments are perfect examples of how compounding is generated at its lowest level. Compounding means making money on money already made. Adding new shares in this way from dividends that are coming in from stocks that are already in the portfolio fits that definition exactly. It's making money from money already made. The money received, of course, is the dividends that have been flowing in since I made the last purchase. And the money that will be made, the additional money that will be made, are the increments in dividends that I've been showing you, in this case $18 a year from the 7 new shares of Merck. And the second thing I wanted to say about this reinvestment is that it illustrates how I generally invest. I pick out a high quality company at a time when it is selling for a good price and at a time when I have money to invest. To do that, I keep surveying the landscape for companies that fit my needs and are well valued, and I try to grab them when I have some money available to buy them. I don't care what order I buy stocks in. I like to do that. In other words, picking out good deals each time I have money to invest, rather than chase 1 or 2 stocks relentlessly, no matter what their price may be doing, to build up a position. My way, by hopping around, because I don't care what order I buy stocks in, I'm simply looking to improve the portfolio each time, I end up with a well-diversified portfolio of stocks, always purchased at least fair prices, if not undervalued prices, and over time I build up a nice portfolio. So rather than chase particular stocks, no matter where they may go, I chase quality and value wherever they may be. Over the long haul, that results in a diversified portfolio. After buying the 7 shares of Merck, I find myself with $58 in cash left over. That begins a new kitty, which will go towards the purchase that I will make in September. So about a month from now, you'll see a video with whatever I decide to buy in September, and that kitty will have grown into the $400 to $500 range. And that wraps up this video. Please remember to click the buttons, and I will see you guys in about a week with my dividend growth stock of the month. Bye, everybody.